Hello listeners, I am Neha Mittal, Assistant Vice President and Sector Head at ICRA Limited. Through this podcast, I will be sharing our views on the residential real estate industry. ICRA estimates the area sold in the top 7 cities in India to increase by 8 to 9% to 650 million square feet in FY2024 on a high base of FY2023, supported by healthy demand and healthy albeit moderating affordability. The top 7 cities considered for analysis includes MMR, NCR, Bangalore, Hyderabad, Pune, Calcutta and Chennai. The sales consistently reached new peaks in each successive quarter over the past 7 quarters, except Q1 FY23 and Q1 FY24, given that the first quarters are traditionally laggards. Despite an increase in the policy rates translating to higher home loan interest rates and rising property prices, area sold in the top 7 cities in Q1 FY24 increased 22% year-on-year, while it moderated 8% quarter-on-quarter sequentially and reached 158 million square feet. As per ICRA expectations, launches are expected to be at a decadal high of around 680 million square feet in FY24, higher 15% year-on-year on an aggregate basis across the top 7 cities, supported by decadal low inventory and comfortable years to sell. The launches in Q1 FY24 were at 131 million square feet, similar to Q1 FY23. With the launches expected to be high in FY24, the replacement ratio is estimated to inch to slightly above 1 time in FY24 compared to 0.98 in FY23. The average sale price is expected to further increase by 4 to 6% in FY24, driven by a change in the product mix with a higher share of luxury units and pricing flexibility arising out of healthy sales and resultant lower inventory overhang. ICRA maintains stable outlook on the residential real estate sector, though the sales growth rate is likely to moderate in FY24 on a high base of FY23. ICRA expects the overall sale velocity, collections and inventory position to remain healthy. The collections for ICRA sample set of 10 of listed entities are expected to increase by 18 to 20%. The net debt levels may increase by around 20% in FY24 given the increased land acquisition for new business development by developers, in addition to the increase in construction finance debt due to a ramp up in project execution. Nonetheless, the leverage as measured by net debt to cash flow from operations is expected to remain comfortable between 1.1 times to 1.3 times in FY24, supported by healthy cash flows. Thank you for listening and stay tuned for our upcoming podcast.